What to make of it then? Mark Todd from FIIG Securities. Mark, warm welcome to you. How much of it was priced in, and the investor reaction to all of it? What was it telling you about the next phase in this soap opera saga?
It certainly is a soap opera. In terms of the bond swap, the credit default issues, it was clear that the banks, and again, it's traditionally, it's the area of the banks that they manage well. It's the risk management tools of the bank, and so it wasn't in terms of cash flow an enormous event. So it works out quite well. The ISDA came through and said, yes, this is a credit default event. Everyone needs to square up their books. What had happened was, in advance of that ISDA proclamation, the banks had already been managing those risks out, so they didn't have enormous exposure in actual terms. You know, I'm countering one trade with another, so they were quite covered. But in terms of the Greek government itself and where we've been in the last few weeks, we've been saying it's the same sort of thing. It's about the Greek government being able to get GDP stimulus. And that comes back to where they're looking to get the funding. They've got this austerity program around. The country's in a death spiral to some extent. It's about how they get that stimulus, and I think they're going to the EIB to try and get that stimulus, and that leads to other questions.
When are we going to get downward pressure on those Greek yields in the coming weeks? Invite in the pension funds, bring in a much needed investor class that's been on the sidelines until now.
I think they'll continue to stay on the sidelines. I think most of the sovereign debts, the problem isn't anywhere near close to being finished. It'll move around from Greece if it stabilises. So in the event that Greece is able to stabilise itself, what it's trying to do is stop the crowding out. It's trying to stop going to the markets to continue to borrow. It's looking for some long-term funding so it doesn't need to come back and be reminded of its predicament every quarter. That's the issue for Greece. They don't necessarily want new lenders, they just don't want to borrow.
Mark, it would be kind of beguilingly seductive to think this is it, and we can shelve the story, but let's just ponder Portugal. Realistically, what sort of an event does that story pose for markets in the next few weeks? Is a red sort of light flashing?
It is. It's like this contagion is an unusual beast. It's like a movie. It just moves from centre to centre. So it goes from Greece and now it looks for something else. And Portugal is the clear next. So in the interim, while I would imagine that the Portuguese governments, while everyone is focused on Greece, would be trying to repair its own balance sheet. And that becomes a European issue. The European issue is GDP. As those economies get slower and slower, the problem of the sovereign debt just continues to move around the track. Whereas you see places like Ireland, who are so off the radar at the moment, and they are just constantly working to try and repair this. And so it's all about time and GDP. So Portugal could be next, but it could be Italy as well.
All right, let's call it the hydra-headed monster.
It is.
For one. John, I know you've got points to put, but it's more, I suppose, on the United States, because the issue for markets very much, as we were discussing before, and Mark, your call on where to for the Fed, I suppose. This is the conundrum now, how to kind of believe that inflation is not a distant threat, but could be kind of coming in on it.
I think you're right, Carson. I think the Fed is the key. I think America has actually turned that corner, and it's much more stable growth. It's a deeper recovery. And so what it means is, how does the Fed respond? And I think the Fed will run as long as it can. It set us out to 2013 for this zero interest rate environment, and I don't see them changing. They'll want this thing to be charging before they start moving around with interest rates. So I think they're prepared to take on that risk of inflation because of where Europe is and because of where we just mentioned China. They need to be able to be self-sustaining. If they were looking to China to be able to marry up and couple up with their growth, that would create a concern for the Fed.
Mark, John Linden from Thomson Reuters. On the Fed, there's an argument both outside the Fed and from within the Fed amongst the hawks that, the Fed is really on emergency settings and have been for some time, and that the economy, as you say, is showing signs of normalization, and that it's not on an emergency footing anymore, and that at some stage the Fed, even if they plan on staying, keeping rates right through to 2014 at extraordinarily low levels, at some stage they're going to have to at least acknowledge that the economy is normalizing and that some of these emergency settings are going to have to go or have to change. Do you see that any chance that the Fed may start to, at least through rhetoric, signal that at the upcoming meetings?
None. I think that my view is that the Fed will hide under the election. They'll hide under the radar as much as they can. It'll be looking for pressure that will come from both the Republican and Democratic parties. And I don't see them being pressured in that way to raise rates. I see them maybe talking about the economy being more stabilised, normalised, as you say. But I don't see them actually reflecting that in interest rate movements. I think they'll say that we America need to support we America, so we will continue to run through for as long as we can on this low environment while the rest of the world is nervous. And within that election cycle, unless you've got some of the very far right wingers saying you've got to raise it, we've got to have that bubble burst, you'll see the majority of people say the Fed's doing a good job. Obama will be patting them on the back saying our plan is at foot, let it run.
Okay, on a follow-up to that, as you mentioned, the election cycle is coming right upon us. Is there, if they don't do any form of QE, whether it's the form that the Wall Street Journal talked about, where they actually, they sterilize it.
Yeah.
If they don't do it very soon, I guess you can almost take QE out of the equation for the rest of the year because of the election cycle. Or do you have that view?
Yeah, correct. I think there'll be absolutely no chance. I mean, I can imagine the environment that Romney and co were able to walk into if the Fed were able to come out and start printing more money. They would, it would rip it apart. So it would have a negative effect, if you like. They'd go back into their insular way to say that, hang on, we're getting into more trouble by printing more money. Whereas the Fed could point to the fact that we're now getting stabilised growth, let's just keep it going. It's actually starting to run by itself. The job figures were interesting in the fact that the government had moved out of the job market and the private sector had moved in. And so that's where the Fed will start to point. That's a very small step in what had been a government-driven employment process.
What do you make of, as well, inside that set of numbers of the participation rate? So the first sign since 2008 now, since this whole crisis swamped markets, of those previously discouraged re-entering the labour market?
I think there's a few behind them. I think the participation rate it's a good sign, and I think the fact that America's starting to turn that corner will mean that more people want to get into the market. But if you look at some of the data around the growth of the population, the ageing of the population, and the actual workforce that's supporting it, there is a lot of people who are in need of work that are not yet in the workforce. Just by natural growth, it's still very weak numbers.
Yeah, well, no one would pretend that one set of data kind of squares it off, but yeah, encouraging signs all the same.
It is.
Mark, thank you. Have a good day.
You too, take care.
Mark Todd from FIIG Securities.